Terry Smith's Investing for Growth. Buy once, cry once is the approach of British fund manager Terry Smith, whose fund Smith launched in 2010. Imagine purchasing a vehicle in two worlds. You buy a high-quality automobile in one world, in the other you purchase a dumpster-ready one. The good one costs as much as 3 of the lesser one, causing minor tears upon purchasing. The high-quality automobile drives you around rural road and city streets over the following 10 years. In the alternative world, the inexpensive automobile rusts after a few years, with brakes failing and a clunky transmission. In the cheap world, you'll weep more over time. This is true for many items we consume and purchase, including stock market investments. Terry Smith, a British fund manager, has bought only quality stocks since launching FundSmith T-Class. This video shows how he believes in quality without overpaying. FundSmith has returned 6 times investors' money in a little over a decade. This is a synopsis of Investing for Growth by Terry Smith. Here's the Swedish investor with stock market investment suggestions and tools. First takeaway: car, excellent. Alex Bird enjoyed horse racing 50 years ago. In Bird's day, picture finishes weren't computerized. Thus, it required time to develop the film for tight races. Even once the race was over, bookies kept establishing odds. Bird had a winning plan. Many in the audience assumed the horse farthest from the crowd was the winner because it looked to travel the quickest. When Bird closed one eye, the illusion vanished. He gambled knowing the result. With hundreds of accurate bets, Bird gained a fortune. We want to be rich. Should we ditch the stock market and rebrand as the Swedish horse gambler? No, it's not. Evaluate firms with one eye closed. Mr. Smith recommends investing like Bird's horse betting. Wait for the bookies, the market, to establish the odds when you know who won. Choose a winner. You must be more vigilant about pricing and chances in the stock market than Bird was with horses. How do we identify winners? Both the IT and consumer products industries have winners. Winners include Apple and Monster Beverages. Buffett calls this the silver bullet. As industry competitors who did shoot with a silver bullet. Companies that others fear are usually industry winners. If you're like me and can't find such viewpoints readily, try these: high gross and operational profit margins, high return on assets, and growing market share. Compare like with like. These enterprises cost more, but that's the price of solid moats. Even such organizations may be discovered at a bargain, as we'll see in the third takeaway. Second takeaway: don't overpay for gadgets. Know those automobile rear set TVs? I classify them into useless items that some people feel are important. Dividend investors protect your ears. TV screens are like dividends, occasionally lovely, but not a significant influence. Fast-growing corporations seldom pay dividends, a recurrent criticism. A college graduate may say, a corporation that pays no dividends is worthless, and provide a calculation. This wise ass is technically accurate, as there are no dividends. Because the corporation doesn't pay cash now, they presume it never will. Class, quiz time. No peeking at Anna Charles. In 1980, Warren Buffett did well with Berkshire Hathaway. Some wise asses believe Buffett must start paying dividends, its shareholders' right to partake in investing earnings. Would Berkshire have produced the same wealth for its stockholders if it paid a 50% dividend over the previous 42 years? Long-term Berkshire owners would not have gotten the same benefit from a dividend. 2 reasons. Berkshire Hathaway has returned more than $1 for every $1 invested. Second, investors lose money when dividends are issued due to taxes. This reduces long-term compounding, much like excessive fees in actively managed funds. Buffett has tried to minimize friction costs. Stock appreciation and dividends produce market wealth. It's often better for shareholders' overall return if a corporation reinvests its profits and skips the dividend, as the money helps the business. Prominent firms should recognize when that's the case, and you shouldn't dismiss an investment because there's no dividend. In certain circumstances, a lack of dividends is a good indicator. Purchasing exclusively dividend-paying firms is like buying a vehicle with a worthless feature. Third takeaway, hold off until there is a discount. Most feel Tesla has excellent development potential. You'd undoubtedly agree that Microsoft has a shark and a crocodile-filled moat. Apple's high-end position in the electronics market may provide its pricing power, like LVMH's in fashion. Suppose you assess a company's quality, not its pricing. First-level thinking is to blame. Howard Marks states, "No concept is good or poor regardless of price." Buying something that grows 20% per year for the next 7 years will be a bad investment if the stock is priced for 30% growth. Opportunity awaited the patient and prepared. So, is discounting a great firm? Who wouldn't like the intro's high-quality automobile at a 30 to 40% discount? Mr. Smith suggests picking up market darlings while they're unpopular. You'll discover value drops when you look at particularly every grand business narrative, like the four above. If you have a list of your most wanted gems, you can get one at 40% off its peak price. There are similar themes in unjustified discount scenarios. Poor quarterly results. When a P&E 40 darling reveals a disappointing quarter with 20% growth instead of the market's predicted 35%, its stock price might drop. A year is merely a loop around the sun, explains Terry Smith. A quarter is 1/4 of that. Who says business must flow celestial bodies? No magic. A 3-month shortfall may transform a firm's mindset from "this business is taking over the globe" to "will this company even be there in 5 years?" You may buy up fantastic firms at reasonable rates when everyone else is short-sighted, a universal panic. Everything falls when the herd of sheep runs in the same direction. In this case, clicking the sale button. Why can't fund managers beat S&P 500? Sheep are butchered. Despite the epidemic, many firms and industries benefited. Microsoft's stock fell 25% even though it took some imagination to imagine how the new infection might affect their operations. If you're fishing in these seas of significant firms with above-average multiplies, wait till the next storm. How can you spot a bargain? Fourth takeaway, don't be fooled by paintwork. P&E ratio is probably familiar to most of you. It assesses a company's price. Did you realize it may trick you like a good paint job on a poor car? If you bought a second-hand automobile, you'll likely encounter this. When you peek beneath the hood, it's a disaster. In the stock market, its profits seem terrific, but weren't. Unfortunately, a mischievous CFO may easily manipulate a company's results in our favored P&E ratio. Earnings per share may not be expanding as rapidly as you imagine since new shares dilute investors. The pie is growing, but so are the stockholders. Instead of diluted stockholders, earnings manipulation might cause mild crying. The CFO may inflate or understate depreciation, or a corporation may capitalize more expenses than necessary. How can an investor avoid examining a crash for hours? Mr. Smith suggests a more solid alternative to profits. Per share, FCF yield. Company cash flow statement. Divide cash flow from operations minus capital expenditures per share by the share price. Warren Buffett has never explicitly calculated owner's earnings, but I believe the FCF yield is close. You may use this cash to buy other firms, pay dividends, or save for a rainy day. Fifth takeaway, no car can be declared a real all-rounder. Teslas are great city cars. Sometimes you'll have to see your 10-hour-away mother-in-law. You'll probably want another automobile. Should you ditch your Tesla over this? No! You can't find an optimum vehicle in every scenario, and the same goes for stock market businesses. Many investors chase performance by switching investing methods or fund managers. Your friends leverage the S&P 500 by 300%. Plan may have surpassed your growth at a reasonable price strategy in 2021. Why switch? Several aspects determine market popularity. Macro variables affect investors' risk tolerance, including interest rates, inflation, and economic cycle position. Again, a year is when the Earth orbits the Sun. Why would you assess your or someone else's success over a year based on celestial bodies? Ideally, we should evaluate performance after both a bull and a lousy market. Then you'll know whose plan won. Stay faithful to your method. Otherwise, you'll buy high and sell cheaply until your portfolio is empty. Industry leaders are frequently suitable investments. Dividends are helpful but not required. For the patient and prepared, you may buy even the most substantial firms at reasonable prices. Avoid becoming fascinated by a paint job by evaluating FCF yield. You should assess investing methods at least throughout a complete market cycle. I hope you liked and learned something from today's video. If you want to keep improving and being inspired, subscribe and press the bell button to be alerted whenever we upload a video. This has been Market Profits Institute.